morning, good evening, good afternoon, wherever you may be coming from. Thanks for joining this call. We're trying this format a little bit differently. I'm doing a pre-recorded version. And the reason for that is, of course, you can see kind of here, yes, I have a newborn baby. So evenings become a little bit more tricky. So we're going to try this and see how it goes. If it works great, we'll keep to it. If not, we'll switch back to the live sessions. But yeah, without further ado, let's go ahead. Okay, so I'm going to skip the intro as I always do every month because if you are interested in this, you can go back to one of my pre-recorded sessions. I talk a lot about who I am and what I do and my passion for eToro. Okay. So summary, where are we today? So if I were to look at the just purely based on stats, we actually haven't done too badly. As you can see from the screen, we've done like plus 5.9%. And if you guys know me well, I'm more proud of the fact that during a really bad year, we lost less than the market, and during a good year, we made more than the market. So we're back to more than break even. If you were to buy an index or anything similar, like just say the SPX, you're still actually down over the last 20 months, right? You're still -8. Whereas if you're with us, you'll be about +4 thereabouts. These numbers are from last weekend, so they may not be that up to date, but you kind of get the point. Because when you lose during a losing year, if you lose less, it's much easier to claw it back. For example, if you lose 50% in a year, to get back, you can't make 50%. You have to actually make 100%. That's just how math works and how investment as a whole works. So yeah, I'm pretty proud of where we are. Last update call, I said, we faced some issues. We weren't doing as well. But I think this month we've kind of caught up with the market and where it should be. So pretty happy about where we are at the moment. I'll go into more details about how we see the market and the rest of the year, but that's kind of a summary of where we are. Okay. So I always do this thought of the call like kind of some academic principle or some principle that I use in finance that helps me with my investing approach. So this month I wanted to cover something that's kind of interesting and is relevant to what we have to talk about today. So one of the things that people do and they build models around is this idea of macroeconomic data or data sets in general, right? And you can see here, this is the Bank of England. What they've done is they actually have estimates available for 1086. So that's interesting macroeconomic data, right? Like a millennium of macroeconomic data, as the headline says. But if we think about it conceptually, this data set actually covers like the period of the Black Plague, like 1346 to 1353. This is a 8-year stretch, I guess. How accurate do you think like GDP data will be during that time? It's a question. Like it's hard, right? Especially considering the technology they had back in the day. How would you get accounting rules across back to the Bank of England? So all that becomes very challenging. So if you're basing your models and your investment assumptions based on data that's trained in 1346, obviously things have changed quite a bit. Is it really that accurate? And I'll illustrate another example. This is a Black Friday picture from Black Friday, right? And this is really the recording of the prices on that date. As you can see here, 150, 145, 135, blah, 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 and it drops a lot, right? So this is one of the worst days ever in the stock market. And this is the data that you have from the day, handwritten notes. And today, when we download any data from Yahoo Finance or investing.com or whatever, we generally have this like high, low, medium, low, close and all that. So it's a lot more data. So what I'm trying to say in this is there's just a lot more data that is available now that's useful. And back then they just didn't have as much data. And so when you're basing your assumptions or building your models, it's good to think about these things and see if they apply and if they apply well. Okay, that's just an example, and because I saw that Black Friday was quite some time ago, this is just from Wellington Stock Exchange, right? It's 1989, which is not that not that long ago if you think about it. But yeah, they're still drawing with chalk. So I've heard a lot of podcasts from academics that said, when we look at data from the past, it used to be just scribbles on a piece of paper. And sometimes for days, the market just doesn't trade, and they just don't have any data in between those days. And maybe the day after, when it comes out, it'll be like scribbles on a piece of paper that may or may not look very, very legible. So it becomes a tricky situation. Of course, now with much better data recognition, you can there's more things you can do. But again, quality of data is kind of interesting. Okay, and there's this like really good video from Baron Perception on YouTube that's available. If you guys have time, it'll be great to watch it. One of the things that he says is 90% of the battles are won by choosing just the correct data set. And most data that makes the news, like GDP and non-farm payrolls, they tend to be useless. And these are his words, not mine. And the reason he gave is like 20 years later, data is still being adjusted, sometimes because of demographic factors or whatever. And we have to remember that these economic data sets, they are not used to help us make money. Instead, they are there to help policymakers think about how to do planning. So that becomes a tricky thing. He also says like not all data is useless. If you think about like building permits, those are things that, or jobless claims, those are things that tend to not change because people claim their jobless claims, right? And that's a certain benefit, and that will help policymakers do a certain budget. So those things don't change as much. Building permits likewise. But if you look at like non-farm payrolls, then those things change like pretty often. Okay, so yeah, that's my thought of the call, and it's quite relevant to today, so I'll get into that in a little bit. But first, we'll just go into where we think about where the market is right now. And there has been a lot of like talk about like, is this a soft landing, a hard landing, recession, things like that. And as always, characteristic of my calls answers, I don't know. But I'm beginning to weigh that, like, we're going to the market, and if we look at just how much we have moved, right? Just from just the charts, just looking at where the market's moved, we are still pretty close to all-time highs. As of I think a week ago, we were just 5% off the all-time highs. This is the Nasdaq. Right now maybe we're sitting about 11, 12%. Again, this is a bit old. It's probably closer to 9 at the moment, now that I think about it. But we did have a significant drop, right? We dropped 36% just last year, 2022, in the first half of last year. So when you go back and look at like, okay, will it be a soft landing, will it be a hard landing? It's very challenging because interest rates have gone up so much. And does it make sense for us to be 5% off the all-time highs when interest rates have just done nothing but go up in a straight line? It becomes from a valuation point of view, especially from a fundamental valuation point of view, it definitely doesn't make sense. Because what happens generally in the market is you expect equity to return more than like bonds or whatever. So equity should always, this is called pecking order theory, equity should always return higher than like debt, and more so than cash, right? So what happens now is that since your cash rate has gone up so much because the Fed has raised interest rates so much, your equity should in theory return more. So can equity return more than set 5.5% a year? So it's like 7-8%. Maybe some stocks can do it, but not a lot. And again, you gotta remember, this is like talking about profit return on capital, not just growth numbers. You're really just discounting cash flows. When we can't talk about finance and a very fundamental perspective, we're just looking at discounting cash flows. I don't think we're gonna get there, and so when I look at the chart, this becomes extremely challenging for me. It doesn't mean I'll short the market. Again, as you guys know, I don't really like shorting. I don't like doing long short positions because of amount of leverage that we have available. eToro has introduced this fantastic product, which is just 0% cost to short. certain types of stocks, and that's great. And we may use it at some point going forward. But for as of right now, it's a bit tricky for me. I don't know where the stock market is going to go. I think if it goes to all-time highs, I'll definitely want to put on just as a hedge kind of position, or even close to all-time highs. I do want to put on a hedge kind of position. But as of right now, it's very tricky. And one of the things that yeah, so this is kind of where I'm at. I really don't know. Another thing that I'm looking at is I do believe that US will head into a recession. That's just my belief at this point of time. And Europe likewise is also likely to enter recession or has already entered recession. And Europe's likely to go first over US. That's just, again, my perspective. Various reasons for that, and especially economic data. I know we said just now we can't really trust economic data, but it is one of the things that we see. Like, okay, so are people really picking up manufacturing in Europe? Answer is no. Is inflation still high? The answer is kind of yes. It's coming down, but it's still high. So what's going to happen there is tricky, because especially because Europe stocks aren't doing as well as US stocks. I do think that the economy, not just stocks. The economy is not doing as well. It's going to be tricky for Europe, especially with high interest rates. So Europe seems a bit more shaky to me than US, but I still believe that US has the potential to enter recession towards the end of the year. Okay, so, and one of the things that is kind of frustrating is if you were to look at like this month, the reason why we kind of performed pretty well is because we have just been participating in nothing but special situations. So SIMO is of course one of our really big wins. BKI is a special situation. Nano Dimensions, GLE, which is Societe Generale. These are all special situations. So in Societe Generale's case, we had the crash of the Silicon Valley Bank, and all bank stocks were taking a beating, right? But we looked at the quality of GLE and we were like, oh, the quality is pretty good. So even though all bank stocks have suffered, let's go and get some GLE, because I don't mind holding it for a while. Quality seems pretty good. Nano Dimension, they had some activist events going on, so I thought we could make some money off of it. We were very lucky on this one. The activist events didn't happen, but we still made some money. BKI, of course, was a merger arbitrage situation. It was a yeah, same with SIMO as a merger arbitrage. SIMO I'll get into a bit later, but for BKI, for us it was pretty. These are all the trades that kind of made our quarter and one of the reasons why we did so well is because all these special situations, and I've learned all this from reading Joel Greenblatt's book. So if you all have like time and you want to learn it, this is a great book to learn about special situations and how to invest around them. Okay, but coming to this quarter, the frustrating part is, as you can see, or if you guys are copying me, obviously, you can see we don't have that many trades on. In fact, we only have like 18 assets, and some of them are like overlapping ideas, right? The well of ideas has gone a bit dry, so we are holding quite a bit of cash as well because of this situation. I like the positions that we have now. It's just I always like to have about 20 assets, which we don't at the moment. Plainly because I've been searching and I don't see anything that interesting that I want to put my money in. And for those reasons, we're just sitting on cash, and I'm very lucky. I get diamond status because of my popular investor reward or kind of scheme. So I do get 5% interest on the cash that sits on my account. With Platinum Plus, of course, it's 3%. It gets lower and it's tiered and all that. But yeah, I'm happy to get 5% cash for just basically sitting there and just waiting. I think 3% is great as well. It gives you optionality. If we see great opportunities, we can go in. But right now, just the pure number of assets that we have and ideas I've been looking at trading is just not that interesting. So I prefer to hold cash than just I'd rather buy something because it's good and it's a good stock rather than it's because I'm bored. That's the worst mistake you can make as an investor. Like you just do stuff just because you're bored. I think that's a really bad way to go. Okay. Yeah, and so we'll go into like the notable positions in our portfolio, and we can let's talk about like why we did so well and where we think the next few months is gonna go. Okay, so for SIMO, this is an interesting one because what happened is that this was a merger arbitrage deal, meaning that we're going to get acquired at a certain price. The stock was trading much lower. And the fundamental reason behind that is because a lot of people thought, this is China, this is a Chinese stock, it's Taiwan, there's huge geopolitical tensions and all that. So it's trading at a significant discount. I think it's like $66. It's supposed to be acquired at like a 90 something dollars. So it's a huge spread, right? And the day that we were correct in one sense. So we're correct in that, okay, China is still likely to play ball. They want to see, they want to appear to be still a very open for business. If they block all deals, it looks very bad on them. It looks like it's very hard to do any kind of business. So our sense was that, okay, unlikely they're going to stop this deal. They've gone into talks and all that, so chances are they're going to approve it, and they did. So we were correct. And what we did is we closed it out immediately at market open. And the reason why we closed it out, okay, so this is one example, right? This is all the news headlines. It's like China using merger reviews to make business difficult, and to us that just isn't true. So that's why we bought into the company. And also, it's a great company, to be honest. Like I do like the sector, I do like what they're doing, so we bought into it. But yeah, what happened was that on the day itself, the news, it skyrocketed, right? You can see the prices skyrocketed from whatever it was here and skyrocketed in 96. We sold out about 89, 91 because I don't like to hold stocks that go into mergers on your eToro account because of legal reasons, I think. When you do copy trading, they have to put the stocks back into your account, and that creates a lot of difficulty because I cannot control those anymore. You have to liquidate yourself, and I know that I have a lot of investors who are completely hands off, which is fine. And those, it makes it tricky to copy, right? So we realized most of the game. So no point holding on for the last like 10%. To me, that didn't make much sense. So we closed out. We made 60, 80% on that day. And there wasn't much sense in holding out the rest. So what happened was it dropped all the way back down after markets because Max Linear pulled out the deal and they said, okay, deal's not going through. They terminate the acquisition. So shot up 76%, and then chipmaker Max Linear terminated the deal. So in a nutshell, if you don't remember anything, how lucky are we? We are just so freaking lucky. Like the circumstances just allowed us to make this money. It doesn't mean I was smart, I was good. I mean, we got the thesis correct. But again, it's a lot of luck as well. If we held it another day, we wouldn't have made that amount of money. So it was a great part of our portfolio. It's a very significant part of our portfolio. So that's why we, it attributes a lot of our returns for this quarter, especially. Okay, and again, the bane of my existence seems to be the US dollar CHF. This I posted, and I've covered this for like, I think, close to a year already. Like, Switzerland's probably not gonna have as bad as inflation as US, or not likely to raise interest rates as much, and this has been true. And what's happened is that we just hold the position and see how it goes, and if we make this great, if not, we'll try and manage it, just try and get the interest carry. So the last call I covered that US is still outperforming Europe, but the dollar is still suffering. In most cases, if you have a stronger economy, your currency should do better. And the recent run up, this just has not happened. So we have taken an absolute trashing on this position. Yeah, so our entries were about like 93. Our first entry was 93, and it dropped all the way to like 90. And everyone was like, "Oh, are you still holding on to position?" And it's like, "Yeah, I still believe in it." And it dropped all the way to 85, and that was like, "Oh my gosh, like, have I got this so freaking wrong that now we're at 85?" Yeah, and when we look at this, it's gone from 101 above par all the way to 85 without any significant move back, right? So it's just been a one directional trade, and we just got beaten up this trade. So I still believe in the trade. but I'm trying to get us back to break even and just make off the interest carry instead. And what this position also serves to do is, if we do actually see a recession, this trade should do pretty well, because as you know, the US dollar performs well during like a panic. There's a safe haven asset, so people all rush into the US dollar when things are turning badly. So that's why like the US dollar appreciated so much last year, and this year has just absolutely just been destroyed. Okay, but yeah, so that's our position. What did I write here? Okay, and if you look at just US dollar strength as a whole, one of the things is you can look at is the index. As you can see, the index has done better than our dollar Swiss position, and that's really because all the all the US currencies have done really well against like Asian currencies, Chinese yuan, Japanese yen, and Thai baht, and all these other Asian currencies, right? But it's done really poorly against European currencies. And like we said, if Europe enters a recession, I think this trade could do like really, really well. If US enters recession, this trade could do really, really well. And it's not correlated with the rest of our portfolio. So it acts as like kind of a diversifying factor, which I really, really like. But right now I'm looking at it, I'm like, okay, let's get most of the position closed, kind of back at break even, which is about 0.9. And we'll leave like some part of the position open, but we'll definitely close most of it at 0.9. And then we'll see how we go from there. But again, if you look at the stats or you do the numbers, there are refunds on your portfolio. And this is from the interest rate differential between US and the Swiss currency. And this comes in the form of refunds. So if you go to your positions and open it, you can see this like refunds, right? So, and also we had some other trades like the Euro US dollar, which we just did to hedge the position a little bit, and we made some money off of that. So when I look at the total position sizing and how much has been affected as of last weekend, these are numbers again from my account, and my account size is about 80,000, 70, now it's about 80,000. It's like altogether our price impact is about 1.42. A lot of it is still stuck in refunds, which again, you will see in your account as realized P&L, but a lot of it's stuck here. So what we're trying to do is we'll try and get back to like 0.9 and close most of the position there. Oops, what did I just do? Yeah, we'll try and close most of the position at 0.9 and see how we go. I do like it, so again, we will keep a portion of position open and try and recover that break even, and that should get us some pretty good returns. So yeah, again, this has been a bane on my portfolio, and it's the largest position, so everybody's asking me about it. I like it, it's just not been in our favor, and hopefully it does turn. And I don't think we're wrong yet. If we're completely wrong and the thesis is wrong, then sure, let's exit. But right now, I don't think we're there yet. Okay. Next one will be Comstock Resources, which I've covered many times. I do like this a lot. And the reason being is that if you look at the green movement, the worst kind of energy source that we have is coal. Next is just crude oil in general. Natural gas, and at the top, of course, is green energy like solar and wind. Solar and wind are great energy sources, and I do believe in the green movement. It's just that it's not ready as its current moment. Like you need like a huge jump in battery production, and cost of running these wind farms would have to come down as well. But yeah, I do like the other two, which are just below it, which are still considered green sources of energy: natural gas and nuclear energy. So these are two that I really like. Having said that, natural gas prices have just taken a beating, right? So looking at just natural gas prices, it has just fallen from like $10 or whatever it was last year down to $2.50. So you're talking about 80% drop. It's recovered a little bit from the time we've entered. So we entered about 2.3 kind of area, and now it's like 2.5. So it's recovered a bit. And our position is kind of at break even. It's dropped. It was like -10 at one point of time, but it's now about break even. But I am hoping that it's gonna go up to about $4. And the reason for my target $4 is I can see that Comstock Resources has the best EBITDA margins, which means best operating margins in the industry, or one of the best. And even then, they still need a break even. They still need prices to kind of be at 346 to break even. So for them to actually make a decent amount of money, they will need to hit about $4. And the reason for this difference is because of the exploration. They have to spend on exploration. Maybe they can bring this down a bit to $3+, but at current prices at 250, it's not profitable for them. So if it's not profitable for the best margins in the company with the best margins, it's not going to be profitable for the entire industry. And this is really why cyclical stocks happen, right? They do really well when the price is high, but when the price drops, what happens is that they don't do so well, and they act cyclically. That's why it's called cyclical stocks. And this is where we try to catch the bottoms of these cycles. And right now for natural gas, it seems like the bottom. So this is something we're trying to do. Okay, and yeah. So Comstock Resources, we just did a simple discounted cash flow model. As usual, I use like ridiculous assumptions like 0% growth rate and 20% return. And we still have a 61% margin of safety. So at the time of recording, we did Comstock was about $9, $9.25, and fair value is at 24. I'm pretty confident we can hit $14, $15 since one of our largest positions in our portfolio. So I think this will do really well. But again, we'll have to see. But I think it'll do really well. Daniels is a new one. We just added it this quarter. I love this stock. It's one of those stocks I look at it and I'm like, how does this stock exist, right? And every time I see one of these, I get very excited. Reason being is it's just such an unloved sector. Nobody loves shipping anymore. And I think Gavin McCauley and Copy Traders podcast did one with a bunch of people, including Stephen Budgeon. And on the podcast, everyone owns Zim Shipping. And yeah, I understand why. This pays a great dividend, but just from a valuations point of view, just from looking at the balance annual report, I like Daniel so much better. So looking at it, it's a cash flow generating machine. It has minimal debt. Has great price to book ratio. They've reduced their debt over the last few years, so high interest rates will not affect them as much. Average duration for the charter remaining is 3.4 years. So what we can do is we take the last quarterly cash flow and we took half of it. So this is just ridiculous, right? You take last quarterly and you halved it. It's crazy. And we assume zero growth for the next 3 years because of this average charter being 3.4 years. And we assume a negative 7% growth for the next 10 years for the entire company, right? And we use, again, 20% required real return. We still have this ridiculous margin of safety of 36%. So even with ridiculous assumptions and like unrealistic expectations of the company, it still trades at a discount. I think this is a great stock. So I get very excited when I see these kind of stocks. So yeah, I hope this will do really well for us as well. Yeah, so this is assumptions. Okay, so this is assumptions. If you guys want to have a look at it, I'm just leaving this out there. Oh, I did a -5. I didn't do a -7. But yeah, the margin of safety is higher for this one. So a bit of change in the numbers, but you kind of get the point of why I like this stock so much. Okay, and on to the next one. This one's going to be a big one because it is, I would say, the largest theme in our portfolio. So it's not the largest position by size, but in aggregation of all the stocks that we have Alibaba, we have China National Building, which is 3323, and we have 0386, which is Sinopec. So I've added that as well. And I'm gonna spend a bit more time on this. This is something that's kind of frustrating. Okay, so if you look at the way that the media is presenting China, so look at The Economist, right? So this is 2 weeks in a row. China's disillusioned youth and Xi's failing model. So this is not just something that I picked up, but a bunch of people picked up. This guy in Paulo Macro, he writes a really good newsletter. You can listen to some of the podcasts he's done. He doesn't reflexively trade every single cover as a high conviction contra, but this is impossible to ignore. So he's saying that this is a really good opportunity because of what the media is saying, and the media is just like trying to hype up certain agendas, trying to get clicks basically. And this just isn't true when you look at the economy itself, right? So there's some really great articles out there on this, and I've read some of them, and I still believe that China's still gonna do really well for us in our portfolio. It's just the media narrative is so bad, and hence why the stocks are not doing well. Um, yeah, when we look at 3323, which is our China National Building, one of our core positions, we have just fallen so much, right? Like when we got into position, it was like $5 or whatever, and now it's like $4.12. It dropped like 20-30% from the time we first got in. And we've been buying gradually and as it's come down, but I've reached kind of the max exposure I want to have on that single stock. I may change my mind in a little bit because of we have so much cash and the opportunities are so limited, so we may deploy some more. But just looking at that, it's just been taking a beating. But especially when we do like consider this, we did the same like crazy assumptions we did previously for all our stocks. We have like quite a return 20%, we have the book value, and still 44% undervalued, right? And this is not from us, this is from Morningstar. So Morningstar says fair value estimate 620. We got in at 543 and it's now trading at 412. So Morningstar also agrees with us, also this is China Construction Bank. I got my wires crossed. But yeah, so yeah, I got my wires crossed on that. I apologize for that. So, but one of the things we look at is if we assume like negative 5% growth, and we assume that like last year was half the earnings per share to 0.5, you still get a pretty significant discount, right? Margin of safety again. And when we talk about halving last year's returns, right, from 107, you have to remember that China has been in absolute lockdown for like years, right? Do I think we're gonna head back to these like $2 levels, $2.30 levels, especially with all the Evergrande and all that? The answer is probably not. But are we gonna be as bad as lockdown? I don't think so. So now that we have those assumptions, right, it's not gonna be as good as it used to be, but it's not going to be as bad as people think. That's kind of where we have the most advantage, because people generally take a narrative which is yes or no. They rarely do people like play with the in between. So if we look at where the stock used to be, it used to be at like $8. Do I think it's going to go back to $8, especially with all the banking issues with Evergrande and all the property Chinese developers? No. But does it deserve to be at $6, $6.50, or $5? Probably yes. It doesn't deserve to be at $4. So somewhere in between, right? So having said that, the narrative has just been so bad, and it's been very frustrating for us as a portfolio, and also just look at the market in general. So I wanted to add more China exposure, but I didn't want to add more 3323, which is China National Resources. So we added back China Petroleum Chemical Corp, which is Sinopec. And the reason why is actually because we used to have this in our portfolio, and I liked it a lot. So I liked it so much that we made a decent amount of money from it. This is not all the trades, but some of the trades, and we sold it in like early of this year, like first half of this year. So I bought back in as a diversifying effect, still exposure to China, but not the same company. And yeah, I think something that happened on Monday was that the first half net profit like kind of fell on weak demand, right? And this is terrible news. But on the same day, the 386, which is the stock, went up 2.75%. So I think the market is starting to realize that they've over compensated for all this bad media narrative. And we're going to see what happens here, but I still do really like China here. Oh, also, I have to specify, I did trim some Alibaba to buy this as well. I do like Baba, especially at these prices, but the I think it's safer. The downside is more limited if we were to buy Sinopec over Alibaba. So that's kind of why I reduced my exposure to Alibaba. Okay, and yeah, I did the same discounted cash flow model, and again, ridiculous assumptions. You can see here minus 5% growth rate, minus 10% growth rate, and we're still at 34% margin of safety. So I still really do like this stock. Okay. Um, and here I have a chart of, I don't think you can see it, but one is of Chevron and the other is of China Sinopec. So one of the reasons we got so frustrated last year is because when the price of oil went up and kind of skyrocketed, right? The price of Chevron did, but the price of Sinopec didn't. And our thesis back then was simple, right? Let's go and look at oil because people have just overblown this, and let's expose ourselves to oil. So I chose China Sinopec as one of the main ways to hold it. It would have been better to hold Chevron. But as oil prices have calmed down, China Sinopec really hasn't moved as much as Chevron, obviously. And it's still trading at a significant discount to Chevron, right? So Chevron's up 37% from like 2022 or the bottom of the oil, and Sinopec is only plus 12%. So we still have exposure to China as how we want it, and less exposure to oil, which is something that we don't necessarily want. Okay, and this is just fresh off the press. I'm recording this on 30th of August, and yesterday this kind of happened. So Grayscale won the court ruling to start the first Bitcoin ETF. Will this actually go through? The answer is we don't know. This is good for crypto. It's good for our thesis, which was we don't think the SEC or the US can continue stopping this Grayscale from converting to a spot ETF, especially with BlackRock and all that applying. So yeah, it's done pretty well for us. We made I think, was it 17% yesterday or 16% yesterday on that position, and it's a decent sized position. So we did pretty well on that as well. And again, as we continue, this entire quarter has just been special situations and nothing but special situations making us money. But yeah, that's kind of it for my presentation. Obviously, there are no questions today because this is pre-recorded. But always feel free to just drop any questions that you have into my feed. I try and respond to everybody, so do me a favor if I miss it out. Just on a new post, just write it again. I'll do my best to respond. And thank you guys so much for wishing me and my family well. I've never had such great response on my eToro feed before, and yeah, just all the love and warmth. I appreciate you guys. Okay, and that's it. So don't forget to follow my YouTube channel, my LinkedIn, Twitter, whatever. I'm on all the socials. Yeah, you can just go to my website, notadvice.financial, and all my details are there. So yeah, that's it for this quarter's recording. Let me know how you like this format as well, if it works better for you guys. If not, we'll go back to the live sessions and see how that goes. Okay, thanks everyone.